After decades of building a vehicle financing portfolio, we have a landmark deal with a marquee investor that Shriram Finance has brought on board. The objective of our conversation with Mr. Revankar today, who's the Executive Vice Chairman, thank you, sir, so much, is to try and understand whether there is merit in a larger re-rating of Shriram Finance, because you have certain other lenders which trade at far higher multiples, and hopefully this conversation helps bring you, the investor, enough insights to take a decision of whether that's warranted or not. Mr. Revankar, it's always a pleasure, and I know I cannot talk stock prices or valuations, but I can talk about the transaction. You have already told us that it's taken a year in the making. Talk to us about what the possible concerns, if at all any, were when MUFG was speaking with you over the last 1 year. And I know that maybe you may not be able to reveal everything, but give us a direction as to what transpired.
See, basically, when we were looking at raising our equity further, we were at around 20%. And since we have an international rating, in fact, we have a rating from Japan rating agency also, BBB plus. There, the requirement is that you should be around 20, about 20. Because the rating, the way they look at banking rating and non-banking rating, there's a difference.
Right.
So we were definitely wanting to be about 20 at any point of time. So we were looking to raise some equity. We had two options. One, to go through a QIP process and raise for a short-term capital. Every 3-4 years, then you go to the market so that your stock will get re-rated, you may get better premium and all. That's one way to look at it. Second way, try to look for a partner who have a very good international track record and experience in investing into different countries, wherein that you can take something out of them to build the business or rebuild the business in India. So as we were talking to many institutions, I found MUFG is one of the top brand or top bank in the world, 10th largest in the world. And they also have experience of investing in US with Morgan Stanley with 23% and in Asian countries with Philippines, Thailand, Vietnam and Indonesia. And they were also looking at investing in India, because India is now a fastest growing large economy. And since they had already showing some interest in India, they were betting on India.
Right.
And we felt that this is the right opportunity to collaborate or meet them and discuss with them. As we were discussing, they were wanting to be a larger partner. When I say larger partner, they wanted to invest at least 20%, so that they want to be a large partner to the running of an operation. So as we discussed, we felt that we have a similar culture in the organization.
Right.
The philosophies are almost common and they're highly professional, and we also are quite professional in the way we have been doing our business. A lot of similarities, and we felt that we should proceed. And then after that, there were other discussion on what we can get out of them and how they can help us. And we found that their digital play and all, they're quite strong, and that's the one way to take something out of them.
Right.
And then the deal came to some kind of understanding, and we closed. See, here, please understand, even though our promoter holding come down from 25.3 to 20.3, when you have a very strong partner with the 20%, it gives you some kind of a comfort to the lenders. Ultimately, we have to impress the lenders, we have to impress the credit rating agencies. That serves the purpose.
That makes a lot of sense. Let me ask you, this 20% stake, you hinted as part of your answer that they wanted a larger stake. Is this final at 20 or is there scope for an increase?
As of now, our discussion is only for 20.
Okay.
We have not discussed anything about that. Even they have not really talked about going beyond 20. Because if you look at their other experience in India, they were also looking at around 20 only. Because you would have seen from the media that there were some talks of MUFG with other institutions. It was also around the same.
Okay. And does this at all change in terms of control or ownership? Is there anything built around that or a thought process around that that has been discussed or spoken about?
See, they have been giving example of their own investment in the various countries.
Correct.
They have told us that they want the current management to continue. They are happy with the management. They have seen the depth in the management. They have interacted with our senior colleagues, and they are very confident. They have no intention to really, come and run the business or even participate in running the business.
So only 2 board seats. That's all they've asked for and nothing more. Even the managing director CEO role continues with Mr. Sharma as is.
Yes. See, Mr. Sharma will definitely continue as is. There's no change in the leadership.
Okay, and you expect that stability to continue over the next 3, 4, 5 years? Is that the visibility? Because now you have enough capital and therefore you have the visibility for 4, 5 years. And leadership is important when you're trying to grow, and you've said that you want to grow at 20%. A stable leadership will be important. You expect that stability in terms of leadership to continue?
I definitely expect same thing, because that is the kind of understanding we have. And not just 5 years, for a very long, we will have a very long journey together. I don't think nothing will change. And we are trying to build a common vision. We already have some vision built up to 2030. We would like to have a very long vision so that we go on that path without any much of frictions in between.
I'll just shift focus. There has been a non-compete fee which has been agreed as well. How should shareholders look at this? And what's the purpose or what's the rationale behind that?
It's basically, whenever there are business transactions, there is a non-compete clause. Maybe for 1 year, 2 years, you don't start anything of similar business. In this case, we said that we don't intend to start a similar business. They don't want another business to be started by the same promoter, because promoter is going to be part of the management and they're going to remain the promoter. So we are going to remain the promoter for long. There's no question of we starting something else.
And how should minority shareholders look at this? It should not perturb them.
It should not perturb them, is what I feel, because they have a very strong partner, and that gives them a comfort.
One of the other key contours of the transaction is the valuation at which MUFG has come in. It's at around 1.9 times book, and it's a sizable quantum that it brings to the table. I understand that there can be arguments on both sides, but what is your thought process or rationale in terms of the valuation that you've got at 1.9 times? Because certain pairs with a lower free float trade at a higher multiple. So I'm trying to get to how you think and how you look at the valuation.
See, the way market values each of the institutions or organizations are different. We can't have any justification or comments on the same. But we are very clear with in our discussion, whatever is the SEBI formula should play. So at that, maybe we are discussing for nearly 6 months, we decided in advance that whatever is the market rate and as per the SEBI formula, we'll fix the rate. Let us not talk about premium or something additional on that, because the investor also should feel comfortable that there's a fair play for them, because they're coming with a very large check.
You've guided now of a confidence of growing at 20% plus. How quickly does the 20% growth kick in? As early as H2 FY26 itself, while the capital hasn't come in, but you've already got the confidence that the capital is going to come in. So do you start growing right off the bat?
See, I think for this quarter, maybe next quarter, we would not be rushing, but we will be building the capabilities. We need to build the capabilities, even though we have a branch network, we have a management bandwidth, we have a people at the place, but we need to plan for a little higher growth, which we are already preparing ourselves, and that will start. Okay, I think that will take little time, maybe 6 months' time, to start growing at higher rate. Because we have been now talking to various OEMs to see how much more we can increase our new vehicle financing. We have been hitherto limiting to used vehicle with the purpose, because we felt that this is the one area where they don't get credit elsewhere. So it is better to be in that place. But many of our customers are upgrading and moving out. If I'm able to hold them, that itself will give me that additional 5%. I don't have to really go out of the way to bring in new customer to really grow 20%.
And you're not doing this today because of capital being, there is a certain lack of capital. Can I call it that?
I don't think it's a capital issue. It is the borrowing cost issue.
Right.
My borrowing cost being at particular level, I cannot give comfort to my customer who is moving to the other institution for a lower cost of fund.
Right.
Today I can say, I can definitely say, because maybe around 10, 15, 20% of my customer will move. And by giving them that additional comfort, my net interest margins are not going to come down, because my cost of borrowing comes down, which I am passing on to them. That's all. So net interest margin will remain same or even increase.
In association with Bank of Baroda, play the master stroke.
The right way, sir, to look at your business going forward will likely be spreads, right, rather than margins, because you will have a large equity base now. Would your spreads at all change because of this transaction? Because now what you're saying is you might actually go in and lend at maybe a slightly lower yield because your cost of funds are also lower. But will therefore your spreads change, or would your spreads remain as is?
No, spreads will increase because my cost of funds will come down.
Sure.
And I'm passing on the benefit to only select few customers, not all customers. So my spreads or margins will expand.
So margins will obviously go up, but spreads will also, you are saying, go up. So you will actually get spread benefit. By how much would spreads go up? In the near term, maybe over the next couple of years, and thereafter in the longer term, if you can give us both of those in terms of a picture.
There are two things that will play out. One is my strong balance sheet will give me a lower borrowing cost.
Correct.
And credit upgrade will give me additional edge. Plus, I am able to source it from different segment, my borrowing. That also will, because many of the funds, they are restricting their lending to only AAA rated or top rated NBFCs. That also I'll get. So I have a multiple source to bring down my cost. And as I bring down my cost, it will help the borrowers from my side, where I'll be able to pass it on to not everyone, but definitely for few people.
You've spoken about this. You've spoken about a 50 to 75 basis point cost of fund advantage, which you will get right off the bat if there were a rating upgrade. Of course, it will be phased across the tenure of your liability book. but a 50 to 75 basis point. But you've also spoken about a 100 basis point increase. Is that because of your equity base getting larger? How should one think of 50, 75 and 100?
All put together.
All put together will be 100 basis points.
Because see, ultimately there is a cost of borrowing on my total book.
Right.
Incrementally, when I borrow, I will have 30, 40 basis point and advantages on incremental borrowing. But my book cost of borrowing has to come down. That will happen over the next maybe 18 months. And that will be permanent.
And will your entire book reprice over the next 18 months?
18 to 24 months it will reprice.
18 to 24 months, your entire book will reprice. So you should see, maybe if I were to say 6 months from now and thereafter another 24 months from that point, conservatively,
Yes.
you'll get a full 100 basis point advantage in terms of your cost of borrowing.
Yes.
Which would likely be around 2.2 lakh crore currently. And at that point, you'll be growing at 20% as well, and you'll add the 40,000 crore in terms of equity coming from MUFG. Is this the right way to think?
You're right. You're right.
Okay. And so what kind of OPEX synergies will likely play out? Because you'll grow at 20%. Are you looking at new geographies to grow in? So will OPEX continue to remain elevated? Will it start to come off? Will you play the operating leverage game or not?
That will be automatically coming, but it will not make a big difference. See, our OPEX, if you look at our cost of operation, is one of the, with peers, is one of the lowest in the industry. So there is a little scope, but definitely it will come down with increased productivity. The productivity gain happens because of a digital play. And as we are increasing our digital play, definitely the productivity gain will be there, then OPEX will come down. It may make around, maybe we are at around 28% cost, this one, of the OPEX cost, which will come down to maybe around 26% over the 5 years.
So marginal.
Marginal.
Understood. Okay. So that will not make a dent on the ROA, clearly. It will likely be only the cost of funds which will make the dent on the ROA. Also, with regard to geographic growth, how comfortable are you? Because in the past, you've had your set of issues with regard to lending in terms of credit cost. How cautious will you be this time around? Because now you've got fresh injection of capital, so it gives you liberty to grow. But how cautiously will you grow is what I'm trying to get to.
See, we will be always cautious because we are a very conservative company.
Right.
See, our reach in south is very good.
Okay.
West, we are very comfortable.
Right.
Our reach is little less in central, north and east. We need to strengthen that. And also, fortunately, these are the states which were growing slowly in the past, have started growing faster now. So there is a scope and opportunity in these states. Some of the states have already shown good progress. For example, Orissa has been doing well. Madhya Pradesh has been doing well. So we believe that even UP is likely to follow that and give us a good growth opportunity. So once the UP, which is around 25-30% of our population, grows and matching with other states, definitely the scope is much bigger.
You've mentioned time and again that there is no intent to convert to a bank. Why is that so, sir? Your cost of funds falls automatically. Why not convert to a bank?
No, see, why I should become a bank? I'm a lender. Bank also is a lender. Now, bank has multiple activity, including your savings account, your overdraft, credit lines. There's so many activities.
Sure.
And our business is simple business of lending against or to acquire an asset. And he will have a sustainable income generated. And that's a simple business. So why should I complicate my life? And one thing, I have a specialization built and I have a reach and I can customize product. I'm more, a customer has comfort with me. Now, if at all, if he has to look at me differently tomorrow just because of a bank, he may feel that maybe the Shriram is not the same company. I have to now look at somebody else. Then I'm losing the customer. So that is one thing. But I feel being an NBFC, we have been NBFC for 50 years, and we believe that this is very comfortable way of servicing the customer. I'm doing, I'm here for a purpose, and that purpose is being served. Then why should I really change?
Right. I understand. And so if one were to just pull the numbers forward to FY28 or FY29, you'll be at roughly 6 lakh crore in terms of AUM. If we were just to do the math at 20%, 6.5 lakh crore, right? That's larger than some of the larger banks also in this country, excluding maybe the largest 5 or 6, right? But you have no aspiration to become a bank nonetheless.
No, we don't have any aspiration to become a bank.
Okay, understood. So at that level, how would the loan mix shift? Would it shift at all, or would you continue to focus on your core, which is vehicle financing?
It will remain almost same. Maybe a few movement will be there here and there. So vehicle financing, machinery financing. Maybe we may get into little larger ticket because of our experience, knowledge in the particular field. So the SME, we have a lot of enthusiasm. We have 15% of my book in SME, and we will definitely grow our SME book. There's a much bigger opportunity in SME, which we will try to keep looking at the ways and means of increasing our SME book. But we will not jump at it. We like to grow very cautiously on the same.
And what would the broad level split be? It would be as is right now, 70% would still be vehicles roughly?
I think so. I don't really see a scope for big change.
And this technology factor, you spoke about it, this partnership or this infusion by MUFG, what it brings to you in terms of technology. Spell that out for us. What changes?
See, we have not discussed on what platform they are in, how to get to know those platforms. We need to visit those places. They need to understand. All those things need to be done. We have not done all those things. Once we do it, then we'll realize where are we against where are they. That it will be easier for us to have a plan. Right now, it is just a thought process.
Okay, and by when would you have clarity on that?
Maybe it will take 6 months to 1 year.
6 months to 1 year. Okay, understood. So at by FY29, FY30, when you're at this 6.5 lakh crore kind of AUM, you'll be doing 3.5% roughly in terms of ROA. Talk to us about the one metric which can probably shift things, which is credit cost. How confident are you of maintaining that 2% odd in terms of your credit cost number?
See, credit cost has been good in the last 2 to 3 years for entire industry, not just to us. Everyone has improved on the credit cost because economy has been doing well. And there is a reasonably good market condition for everyone so that not much of defaults or challenges have come. I think that situation should continue if you are growing at the same rate is one thing.
Okay.
And second thing is, since I would be able to retain the customer, existing good customer who otherwise will be going out, and I'll be attracting a better track record customer from elsewhere because of my lower cost of fund, I believe my credit cost should come down. It may be a small point, 10 or 20 basis point, but that will make a significant improvement in my bottom line.
Understood. But no loan diversification, credit cost, you aspire at 2%. Of course, with fluctuations in the economy, you will see those fluctuations as well. And therefore, an ROA band of around 3.3 to 3.7. Is that the right broad ROA range which you will operate in?
Yeah, our calculation says 3.3 to 3.6.
Perfect.
And probably that will hold good for long.
Perfect. Perfect. So you've given a very good picture in terms of a thought process. Do you believe that there is enough merit in a possible re-rating of Shriram Finance, even from a price to book multiple perspective. Is that something that you would also aspire for?
Definitely yes, because we would like to be appreciated by the investor and shareholders and the market. I believe it's a strong case for us because we have been a strong performer over the years. We have seen so many cycles in the last 50 years, and we have withstood not really having a large promoter holding. See, you can withstand when you have large promoter holding, but without that, we have been managing the business and I don't want to call ourselves as outperformers. We have been performers all through. So I think that kind of appreciation will come through re-rating.
Okay, so thank you so much. This has been an absolute pleasure, as is always when we are speaking with you. Thank you so much for this. Viewers, it's interesting because you've got a 20% growth franchise now, at least with reasonable confidence, is what Mr. Revankar seems to be saying, along with a ROA re-rating, which is likely to play out over the next 3 to 4 years. This could well be a compounding story for the next 3 years. At 10,000 crore in terms of PAT, if we just do a simple math, this goes to 20,000 crore in PAT in 3 to 4 years, which means that you've got a doubler in terms of profit after tax and thereafter book value accretion, which will likely happen. ROEs, well, I didn't ask Mr. Revankar that, but we've had enough of that commentary that ROEs will taper down to 13% and thereafter go up to 15 odd percent. So it's a very interesting story which is playing out. And of course, we had a front row seat with Mr. Revankar to understand exactly that. Thanks so much for tuning in.